Demand from investors for downtown Toronto condominiums is picking up. What do the numbers look like if you're buying an investment condo? We're going to look at that today. My name is John Pasalis, president at Realosophy Realty. You can catch all my latest writings on Toronto's housing market at movesmartly.com. If you find this video helpful, please hit the like button, subscribe to this channel to stay up to date on all my latest videos. So we've been getting, of course, a lot of questions about what it looks like investing in a condominium in downtown Toronto. We've seen a big rebound in demand over the past 4 or 5 months. So what do the numbers look like for those investors? We crunched the numbers. We basically looked at all the condominiums that closed, which means the owner took possession in the first 3 months of this year. And then we checked to see, well, how many of those investors, how many of those purchasers actually ended up listing their units for rent? So out of all the ones that bought condos and rented them out, we knew exactly what they paid for their units. We knew what they rented them for. We knew the property tax. We knew the maintenance fees. We assumed they all put down a 20% down payment and got a 30-year mortgage. So we're able to calculate what the cash flow looks like on average for all of these units. And this is what the numbers look like. When we looked at all of the units bought by investors in the first quarter, the average purchase price was $644. The average rent that they got for their units was $2,000. Their mortgage, I should say, on average was just under $2,000. Maintenance fee on average was $476. Property taxes just over $200. And their cash flow was negative about $669 per month. That's basically the difference between the rent and the carrying costs of the unit. So how does this compare to sort of historical trends? I've had a lot of people mention to me on Twitter, well, this is the norm. Toronto condo investors for 15 years have been cash flow negative on their investment property. So to see if that was true, we kind of turned to Urban Nation, which is a leading condominium research firm in Toronto, to get numbers from them. And what they found, actually what they shared with us, was that up until 2017, condominiums were actually cash flow neutral, which meant that the rent that investors were earning were generally covering the carrying costs of those units. The cash flow negative of sort of the spread between costs and rents actually really started to diverge in 2017 as condo prices started to accelerate. And we can kind of see from this chart that they've been kind of accelerating since then and have hit around just under $700 per month now, because condo prices have really taken off over the past few months. So, how rational is it? Is it a smart idea to be investing in condominiums or any real estate that's cash flow negative? I'm generally of the camp that it's not. I mean, at the end of the day, real estate, I mean, I grew up in real estate. It's a business. You don't really want to have a business that's losing and bleeding money every month. Simply because you think it's going to be worth more tomorrow. I mean, it's generally not a great investment strategy. I think what's motivating a lot of investors is just this assumption that condo prices are going to go to the moon, kind of like low-rise prices have. The assumption that rents are going to skyrocket. I think rents will probably pick up. Obviously, they dropped quite a bit, but are they going to explode the way they did over the past 4 or 5 years? I mean, possibly, but likely not. And the reality is, even if they do, it's going to take a while to kind of justify some of the prices investors are paying right now. So, if you're investing in a condominium, I think the key thing to keep in mind is that you want to be buying for the long term, and you don't want to buy necessarily with this assumption that prices are going to keep rising 10% per year, because the reality, or that rents are going to be rising 10% per year, which is what's motivating a lot of investors. Because the reality is, when we look at what we're building in Toronto, it's disproportionately small condominiums. So when we look at the pipeline of what's kind of coming onto the market, we have a lot of rental inventory effectively, because it's a lot of these units are being bought by investors that's going to hit the market, which will probably obviously dampen sort of any growth in rents most likely, and potentially impact sort of the acceleration in condo prices. So again, I think it's a bit of a gamble again, but a lot of the investors who are buying right now are very optimistic that we're going to see a boom. I'm probably cautious. I'd probably invest in something else, but I think that's what makes kind of real estate investing interesting. Everybody has their own perspective. I mean, for our clients, we're just making sure that they're cautious, they know their numbers, and are trying to sort of tighten up the gap between their rent and their carrying costs, because being short $700 a month is quite high. And you don't want to be that high if you're going to have an asset like that for the long term. Hope that makes sense. If you have any questions, please post them in the comments below or send me an email at askjohn@movesmartly.com.